The most dangerous phrase in personal finance is set it and forget it. Today, March 25th, 2026, many retail investors believe they are holding a diversified basket of 101 companies through QQQM. But the forensic data tells a completely different story. While this fund has returned 94% over the last 5 years, nearly half of your money, roughly 47%, is riding on just 10 companies. If those 10 companies catch a cold, your entire portfolio goes into the ICU. We are auditing a material concentration risk that is currently being masked by a low 0.15% expense ratio. I'm Camilo Motato, and this is Camilo's House. As a professional focused on risk mitigation, I know that cheap doesn't always mean safe. In an audit, we don't look at the 94% gains of the past. We look at the structural integrity of the asset for the future. Today, we are performing a holdings audit on QQQM to see why this passive vehicle is behaving like a high-risk tech hedge fund. The appeal of QQM is its 0.15% expense ratio, the cost of entry to own the dominant tech giants. But from an investigative standpoint, the asset allocation is severely skewed. Nvidia alone represents 8.7% of the fund. Apple follows at 7.4%, Alphabet at 6.8%, and Microsoft at 5.8%. In accounting terms, this is a concentration discrepancy. You aren't buying 101 companies. You are buying Nvidia, Apple, Microsoft proxy with 90 tiny rounding errors attached to it. A 20% decline in Nvidia isn't just a bad day for one stock. It's a direct hit to the fund's net asset value that the other holdings simply cannot offset. Year to date, QQM is already down nearly 5%. As a CPA, I analyze the transmission mechanism of loss. When you have this much weight in fewer than 10 names, you lose the ballast that a truly diversified fund provides. This correlated risk means your passive investment can experience double-digit drawdowns before the forget-it part of the strategy even has a chance to work. The fund targets non-financial companies, which sounds like a safety feature, but it's actually a sector limitation. By excluding financials, you are effectively removing the sectors that traditionally act as a hedge during high interest rate environments. You are doubling down on growth at a time when value and stability are what the market is desperately seeking. Diversification isn't just about the number of stocks you own, it's about the sector independence of those stocks. Today we are digging into the supply chain of QQM, where we find that roughly 2/3 of the fund is concentrated in just two sectors: information technology and communication services. If the tech engine of the economy stalls, the entire QQM vehicle stops moving. We are auditing a systemic sector dependency that makes this fund vulnerable to a single point of failure: the AI infrastructure cycle. Within the information technology sector, the semiconductor subsector creates a massive single-theme risk. As a CPA, I track revenue correlation. All these companies, Nvidia, Broadcom, Micron, and AMD, are currently priced for a continued parabolic increase in AI capital expenditure. If major cloud providers like Microsoft or Alphabet announce a slowdown in data center spending, the ripple effect through QQQ will be catastrophic. It's a circular audit, where the companies in the fund are the ones providing the revenue for the other companies in the fund. Beyond the tech core, QQM carries an 11.7% weight in consumer discretionary. From an investigative standpoint, this is a secondary liability. If the consumer is struggling, then the non-tech portions of QQM won't be able to save the fund. In auditing terms, this is a lack of internal hedges. Most well-constructed funds have offsetting assets. When tech is down, perhaps energy is up. But in QQQM, almost everything is high beta, meaning it moves more than the market. The most important audit finding for QQQM doesn't come from the fund itself, but from the volatility index. As a CPA, I look at the macroeconomic climate. The University of Michigan Consumer Sentiment Index has dropped to 56.4. This is a leading indicator of a revenue miss. From a forensic perspective, if the household balance sheet is under pressure from inflation and high rates, they stop buying EVs and stop clicking buy now. Since QQQM is 11.7% consumer discretionary and 48% technology, it is essentially a macro-sensitive asset. The household pessimism we are seeing today is the unrecorded liability that will eventually show up in the quarterly earnings of QQM's top holdings. Because the top 5 holdings represent such an outsized share of the fund, every quarterly earnings cycle is a concentrated risk event. In professional auditing, we call this key person dependency. But for stocks, if any of those big 5 signal a slowdown in AI capital expenditure, the semiconductor supply chain trap will snap shut, liquidating months of gains in a single afternoon. The final audit of QQM shows a fund that is structurally impaired for the current high volatility environment. While it is a well-constructed vehicle for long-term growth, the assumption that it is broadly diversified is a material misstatement. My verdict is that QQQM is currently a speculative growth asset, being sold as a passive safety net. If you are holding this fund, you are not set it and forget it. You are monitoring every minute. But I want to hear from you. Do you still trust the big tech anchor to hold, or is the 47% concentration a red flag you can't ignore? Is the 0.15% fee worth the risk of a supply chain collapse in semiconductors? Let me know in the comments. Your perspective is the only audit that matters when your retirement is on the line. I'm Camilo Matado for Camilo's House. Subscribe to stay ahead of the numbers behind the headlines. Stay safe.